welcome to Vivegam V+. In the previous class we have discussed about functions of commercial bank and central bank. Today we are going to discuss about credit control measures. There are two types of measures, quantitative and qualitative measures. First we shall see quantitative measures. First we shall see what is quantitative, because it reduces the total amount of money supply in the economy. So we use the word quantitative measures. First there are 5 instruments: bank rate, repo rate, reverse repo rate, open market operation and varying legal reserve requirements. These are the 5 instruments used by central bank to control credit. The first one is bank rate. What is bank rate? Bank rate is the rate of interest which is charged by central bank for lending loan to the commercial bank, but the loan is long term credit. So what is bank rate? Bank rate is the rate of interest which is charged by central bank for lending long term credit to the commercial banks. And second one is repo rate. Here also the rate of interest which is charged by central bank, but it is only for short term credit against securities. But there is a slight difference between these two rates. One is long term, short term, another one is against securities. I think it's clear to you. And next one is reverse repo rate. Here, whenever this commercial bank have excess fund, it used to deposit with the central bank and earn rate of interest, and the central bank has to pay rate of interest for these deposits are called reverse repo rate. Here the rate of interest is paid by central bank to the commercial bank. The next one is open market operation. What is open market operation? Buying and selling of government securities by central bank in the open market. And next one is varying legal reserve requirements. Here what does it mean? It refers to the certain percentage of deposits of commercial bank which is legally to be maintained on 2 accounts. That's we call legal reserve requirements. Already discussed about CRR, and today I am going to introduce SLR. SLR is statutory liquidity ratio. So cash reserve ratio is in the form of cash, but statutory liquidity ratio in the form of asset, maybe a gold, and CRR must be with the central bank and SLR with the commercial bank. And now we are going to see the next subheading, how the central bank is going to use these instruments to regulate inflation. First we shall see what is inflation. How do you describe the situation inflation? Inflation is a situation where there is rise in price, increase in money supply, fall in purchasing power. And now we are experiencing the same situation, that is inflation. What do the banks do? What does the central bank do now? Whether it will increase these rates or decrease these rates to control the inflation. First we shall start with the bank rate. The central bank will increase the bank rate. So why does the bank increase? Why does not decrease? Because when it increase the bank rate, automatically the credit become costlier. When the bank increase the bank rate, it become costlier. When it become costlier, automatically the demand for credit will falls. When credit falls, automatically there is a fall in supply of money. Already we have seen what is the aim of quantitative measures, make a change in the money supply. Now the money supply has been reduced by increasing the bank rate. So this is the first step. And also in the same case of repo rate, they will increase. Here also the same change will be in the economy, because here also the rate of interest is paid by the commercial bank. And next one is reverse repo rate. What do you expect? Here the central bank will increase or decrease. Here also they will increase, because here the commercial banks are enjoying the rate of interest. So when they increase the repo rate, reverse repo rate, automatically they tend to keep more amount of fund with the central bank. When they keep their more amount with the central bank or they deposit more amount, their disposal amount will be reduced. When their amount is reduced, automatically credit creation will be reduced. So money supply will get reduced. So to some extent inflation can be decreased. And next one is open market operation. In this situation, when there is a inflation, a central bank sells securities. When the central bank sells their securities, automatically money supply in the circulation will get reduced. And last one is CRR and SLR. They will increase these ratio. When these ratios are increased, automatically the disposal amount for lending purpose will be reduced. So, by which central bank to some extent inflation can be decreased. So, inflation is otherwise known as excess demand. The next situation is deflation. Just opposite to inflation, we call it as deflation, or we can use the word deficient in demand. So, the reverse will be followed when there is deflation. When there is a deflation, and the bank will decrease the bank rate, repo rate and reverse repo rate, and they will buy the securities and they will decrease the reserve ratios. Hope you have understood quantitative measures of credit control. The next video class we will learn about qualitative measures of credit control. Thank you.